You probably already know that the IRS allows reasonable and necessary business travel expenses to count as deductible business expenses. But did you know that this includes many of the costs associated with an annual shareholders meeting? This doesn't just mean huge mega corporations either. Even a single member LLC that has elected S-Corporation status for tax purposes is eligible to hold an annual shareholders meeting. Yes, with just you, the sole owner and shareholder, in the location of your choosing within the United States, as long as you document it properly and deduct only the ordinary and necessary expenses associated with it. Now, before you get too excited and tell your CPA that the legal consideration channel told you it was cool to take your whole family to Hawaii on the company's dime, there are some important limitations and restrictions that you need to be aware of about shareholder meetings and business travel more generally, which I'll get into next. And of course, don't forget that this channel is for general educational purposes only, so you must always consult with your own attorneys, accountants, and tax advisors for advice tailored to your particular circumstances before acting on any of the general information that I share here. The IRS closely scrutinizes travel deductions, especially for single-owner businesses. So let's start off with a quick review of basic IRS rules, limitations, and key considerations to ensure that you're complying with the law and avoid raising any unnecessary red flags. The primary purpose of your trip must be business-related, and your expenses must be ordinary and necessary. This includes travel expenses for shareholder meetings, strategic planning, client meetings, and other legitimate business purposes. But this isn't a free pass to enjoy the presidential suite in the most extravagant hotel in the city, or an excuse to rent a Corvette for the week. If the trip is basically just a personal vacation where you occasionally happen to check your email while you're there, the IRS will not be amused. Keep watching this video for some tips on how to help audit-proof your business travel expenses, including how to properly allocate costs if a portion of your trip involves personal leisure. One recurring concept is whether your primary reason for travel is business or personal. A good rule of thumb for determining whether the primary reason of travel is business is whether at least 50% of your days were spent on business matters. So, if you fly into your destination on Monday, work Monday, Tuesday, and Wednesday, take Thursday off for sightseeing, and then have meetings on Friday morning before flying out Friday afternoon, then 4 out of 5 travel days, or 80% of your travel days, were dedicated principally to business purposes, putting you well over that 50% threshold. Things can get a bit tricky when weekends are involved, but the IRS does allow weekends to count as business days if and only if you have a legitimate business reason for staying. So, for example, if you have business meetings on Thursday and Friday, and then again on Monday, staying the weekend won't count against you because flying home and then returning would be ridiculous and inefficient. But if you have a meeting on Thursday and then you decide to just hang out for a long weekend, Friday through Sunday, with no other business purpose, those days count as personal days and will cause you to fail the 50% business primary purpose test. Failing the 50% test has major implications, including the IRS disallowing airfare and requiring you to prorate hotel and meal expenses, all of which we'll address now. If the primary reason for your trip is business, if you're over that 50% threshold, you can deduct 100% of your round-trip airfare, even if it's a business class ticket rather than coach. But as we just discussed, if you extend the trip significantly for personal reasons, you may need to prorate your flight expenses. Or if it's a situation where you only spend a couple hours of one day on a 10-day trip talking to a business contact, your CPA may recommend that you forego trying to deduct those expenses entirely. Now, for car rentals, if you truly need a car to conduct your business, whether it's to drive to meetings or a conference center or to scout venues or prospective expansion locations or whatever, then you can deduct it. But if you're mostly using it for personal activities, if you walk to the conference center from your hotel, but then use the car to go sightseeing, then you need to prorate it or forego the deduction entirely. For lodging, you can deduct the cost of your hotel stays only for those days spent on business. IRS guidance also allows you to arrive a day early or leave a day after if it's reasonable for conducting business. For example, if your last meeting on Wednesday doesn't wrap up until 6:30 p.m., you don't have to flee to the airport and try to catch a premium price seat on the fully booked last flight out at 9 p.m. IRS guidance suggests that it would generally be reasonable to stay overnight and to leave Thursday morning instead. But if you extend the trip for a couple of days just to explore the city for fun, you must prorate the lodging deduction. Business-related meals are 50% deductible as long as they are directly related to business discussions. Per diem rates can also apply, but receipts and documentation are better. Historically, I personally have rarely bothered to deduct meal expenses, as the hassle of keeping receipts and the risk of ticking off the IRS can't be justified by a 50% deduction on whatever $12 salad I pick during a business lunch. And your accountant definitely has some horror stories of clients who try to write off the full cost of every single meal or snack that they consume all day, every day, no matter where they are located. Proceed with caution and defer to your tax advisors on this one. These rules apply to all business travel, but now I'd like to narrow our focus to this cool idea of using your annual shareholders meeting as a limited opportunity to travel. This absolutely is permissible, but if you don't document it properly, the IRS could disallow your deduction, even if you actually did do work. Here is how to do it the right way. First, set a business agenda in advance. Prior to your trip, you'll want to draft a formal meeting agenda that includes, first and foremost, the key business topics and decisions to be made during the shareholder meeting. The specifics will depend on your current business situation, but it might include things like financial planning, tax strategy, marketing ideas, hiring plans, internal policy updates, succession planning, and any other short and long-term strategic planning for your business. You may also want to consider bringing in another business expert, such as a lawyer, accountant, or consultant, for at least part of the meeting to strengthen the case that this is a genuine business activity. If the business expert won't attend the formal shareholder meeting itself, but is local to the area, schedule specific meeting dates, times, and locations, and be sure to save all your invoices. Next, keep official meeting minutes. Once you're on your trip, you'll want to actually follow the agenda you set and have a real shareholder meeting, even if you are the sole shareholder and only meeting attendee. If you don't have a secretary to keep official meeting minutes, you should still take notes about what decisions you make, whether that's establishing a budget, writing out and adopting next year's business strategy, solidifying expansion plans, or whatever. Memorialize any key takeaways and next steps that you determine, and you should come away from this with a legitimate list of decisions and action items for the coming year. Next, maintain receipts and records. You also need to be diligent about maintaining your receipts and records for the duration of the trip. Keep copies of flight tickets, hotel invoices, meal receipts, rental car contracts, and any other business-related expenses. Keep in mind the 50% business primary purpose rule, and if you do book any activities that are personal, like a skiing excursion or a spa day, be sure to prorate your expenses accordingly. And finally, avoid excessive luxury. Deductible expenses are supposed to be reasonable and necessary, and the IRS may disallow deductions for anything that's truly lavish or extravagant. Now, what about the question, can you bring family and friends? What if you want to bring your spouse, kids, or your best buddy along for the ride? Spouses are frequently co-owners and employees of small businesses, and in that case, it may well be reasonable for you to deduct their expenses. Likewise, if your spouse happens to be a legitimate business consultant that will attend your shareholder meeting to offer their marketing expertise or tax advice or whatever their specialty is to your business, that makes sense. But if they have no business role, their expenses are not deductible. The same principles apply to your kids, significant other, or other friends. If they're not working for your business, you cannot deduct their flights, meals, or activities. If you decide to bring any of these people along anyway, be meticulous about keeping their expenses separate. For shared expenses, like if you book a suite for yourself, your spouse, and your 2 kids, you should only deduct the cost of the single occupancy rate for that hotel. No surprise, that may be significantly less than the full cost of that giant suite. You should be aware that the IRS does tend to scrutinize trips where family and leisure play a significant role, especially when the legitimate business activity is just barely over 50%. It doesn't automatically disqualify your deductions, but it could invite more questions. Let's conclude by summing up the basic principles. If you want to take tax deductions for a business trip, make sure that the primary purpose is business, you have a legitimate agenda and meeting minutes, you document every business expense, and you don't try to sneak in personal expenses as business deductions. For the avoidance of doubt, you should not try to write off a luxury vacation that's disguised as a business trip, flights, meals, or activities for your spouse, kids, or best friends unless they are directly related to your business, or personal excursions like skiing, concerts, or theme parks. The bottom line is that you can take an amazing, almost fully deductible business trip if you follow the rules. Just don't push it too far, or you may get an unwanted nastygram from the IRS, or worse. Thanks for watching this video. Please check out legalconsideration.com for all the latest on premium courses and opportunities to accelerate your own learning on all things law, business, and finance. The production value is noticeably higher there than it is here, and you can get an in-depth look on the topics that matter most to you, with lots of bonus materials and no fluff. I hope you'll join the Legal Consideration learning community there as well. legalconsideration.com.